The Fed cut rates for the first time in 4 years. What does that mean for your money? Just heard the news? The Fed slashed interest rates for the first time in 4 years. But what does that mean for your wallet? Buckle up, because we're about to dive into the nitty-gritty of how this decision can impact your money, from potentially lower mortgage rates to the possible effects on your savings. The Federal Reserve, the central bank of the United States, recently made a significant decision. It lowered interest rates for the first time in 4 years. This move has far-reaching implications for the economy and can significantly impact your personal finances. Understanding the Fed's rate cut. The Federal Reserve sets interest rates to influence economic activity. By lowering rates, the Fed makes it cheaper for businesses to borrow money and invest. This, in turn, can stimulate economic growth and job creation. However, it can also lead to inflation, a rise in the general price level of goods and services. Key implications for your money. Lower interest rates on loans. One of the most immediate effects of a rate cut is lower interest rates on loans. This means you might be able to secure a more favorable rate on a mortgage, car loan, or student loan. For example, if you're considering buying a home, a lower interest rate can translate into significant savings over the life of your mortgage. Potential impact on the stock market. A rate cut can have a positive impact on the stock market. When interest rates are lower, businesses tend to invest more, which can boost corporate profits and drive up stock prices. However, the stock market is influenced by many factors, and the impact of a rate cut can vary. Potential increase in housing prices. Lower interest rates can make it more affordable to buy a home, which can increase demand and drive up prices. If you're already a homeowner, this could lead to higher property values. However, it's important to note that other factors, such as local economic conditions and supply and demand, also play a role in determining housing prices. Impact on savings and investments. While lower interest rates can be beneficial for borrowers, they can be less favorable for savers and investors. Interest rates on savings accounts and certificates of deposit, CDs, may decrease, meaning you'll earn less interest on your savings. However, the impact on investments can be more complex. Lower interest rates may favor certain types of investments, such as stocks and bonds, but it's essential to consider your individual financial goals and risk tolerance. Potential for inflation. One potential downside of a rate cut is the risk of inflation. When the economy is growing rapidly and demand exceeds supply, prices can rise. Inflation can erode the purchasing power of your money, making it more expensive to buy goods and services. Considering your individual circumstances, the impact of a rate cut on your personal finances will depend on your specific circumstances. If you're planning to borrow money, a lower interest rate can be a significant advantage. However, if you're a saver or investor, you may need to adjust your strategies to account for lower interest rates. It's important to consult with a financial advisor to assess how the rate cut might affect your individual financial situation. They can help you evaluate your goals, risk tolerance, and investment options to make informed decisions. In conclusion, the Federal Reserve's decision to cut interest rates has both potential benefits and drawbacks. By understanding the key implications and considering your individual circumstances, you can make informed financial decisions and take advantage of the opportunities that may arise.